let's start with just sort of an explanation of this deal and why it is a good match.
Right. So PowerShares has 127 billion. Guggenheim has 36 billion. So they're not that big. That would mean PowerShares would be still the fourth biggest issuer. But here's why I think this is a good deal for PowerShares is that Guggenheim has a lot of smart beta products which complement PowerShares smart beta. So the biggest example is RSP. This is their stud ETF. It's the S&P 500 equal weight ETF. It's $13 billion. It's beating the market over the past 10 years, although underperforming mid caps. But still, people just like equal weighting. This strategy really was born out of the institutional world, and they came out with this product in 2004. It was arguably the first smart beta ETF ever. And now retail investors really eat it up. I travel around and people ask me about equal weighting all the time. And so that's why you see a lot of assets following it into this area. And Guggenheim also has equal weighting in every sector as well. So PowerShares is big with fundamentally weighted ETFs and momentum. And then they're going to have equal weighted. So PowerShares will be sort of trying to cover a lot of the smart beta areas within each space. And I think for active shops, Guggenheim would have made a perfect acquisition if you have no passive game because they have this smart beta aspect. The products aren't that exotic, and it would have really gotten you really into the industry quickly. And so for companies like T. Rowe and Franklin that are really behind the curve in terms of getting a passive game, I think this takes a huge target off the table for them.